get a little bearish, talk about the case for precious metals and more with Kevin Smith, the founder and CEO at Crescat Capital. Kevin, I'm on your Twitter page so much, sometimes I just call you Crescat Kevin, which is, of course, your handle. So for those, go check out the charts. Kevin, but walk me through it first, okay? Because I kind of describe you as a bear from our conversations, but I'm looking at this Bloomberg story about your returns on the year. You're up 40% in your macro fund, and you're even positive in July as the market was coming back. So what exactly are you?
Well, we're very bullish on precious metals, and we, you know, as we've been saying for quite some time, sell stocks and buy gold, or as we say, buy gold and sell stocks. Either way, we want to be hedged, and we have a lot of reasons for that, which hopefully we can get into in this call. But that's the gist of it.
So did you go up on the returns? Because I'm just trying to figure out how your portfolio is, kind of situated right now. Did the returns come from the first part of the year in the big crash? I mean, gold's been running since too. So I imagine if you're short stocks, that's been working the other way the last quarter or two.
No doubt, Oliver. That's the issue, really. We did extremely well in March and late February and March on the short side of the portfolio. We were net short in our two hedge funds going into that, our global macro and our long short fund, and did very well. And then we put out a letter in March that we called blood in the streets, and we weren't talking about buying stocks, and we were talking about buying gold stocks, and we cut back some short positions in March, and we really started loading up on our precious metals positions. Now we did not we didn't get out of the short side by any means, and that has held us back in the recovery, especially in April and May, but June, July, and August, we have done extremely well on the long precious metal side of things to really keep us in the game there and have some top returns, at least year to date in both of those funds.
Okay, and kudos to you guys. So let's talk gold here, Kev, because I heard a pretty compelling case this morning from Ben Emmons over at Medley Global that if you look at the way some of the vaccine stocks and reopening trades have been correlated with gold, then it looks like gold struggles if there's signs of recovery. Today, we had a pretty strong employment report. I know folks can still debate that given the high level of unemployment. Bill Lee was on the show from the Milken Institute, said it was shockingly good. So if there is still recovery, where does gold go? Because the case Ben was making is that inflation actually is probably coming, but it still may not be good for gold based on the way gold's been trading over the last year and a half.
Well, you got to realize with precious metals and gold mining stocks, that whole industry, it's really an asset class. We think precious metals is an entire asset class. It got forgotten in what was a 10-year bear market, but that whole industry and that whole asset class went through a 10-year bear market after peaking in 2011. But I know things have been strong since March, and some people might think that the precious metals bull market started in late 2015, early 2016, but we really had a double bottom retest, especially in the smaller cap stocks of those 2015 lows, and that kind of makes it a 10-year bear market for us. And it's early days, and I can talk about more of the reasons macro-wise and fundamental-wise why, but and there's a chart that shows one reason why when you look at silver and gold and precious metals relative to stocks, we are still at extremely depressed levels.
So the gold move, though, over the last year and a half is still, I could see a situation, Kevin, I'm just kind of, hypothetically talking here, but a lot of times you see events happen that people have been talking about and the reasons to buy things, and then when they happen, it actually goes the other way, and they say, oh, well, we're selling the news, or it's like you get an earnings on a company that's been rallying like some of these tech stocks, and then it drops. Ironically enough, actually, gold and tech stocks have been quite correlated over the last 15 months. So do you expect that correlation to break?
Well, in the nutshell, when we say buy gold and sell stocks, tech stocks are one of the big areas of where we're short, and And it makes for a nice hedge, given the correlation that you talked about.
Okay.
But we do think they're going to diverge and break the other way, with gold and gold stocks and silver breaking out to the upside, with tech stocks coming down. And the difference there is plain and simple. It's valuation. One of these industry groups and sectors is a bubble, and the other one is an undervalued opportunity early in a cycle.
You've got a chart of Apple that I think is pretty interesting that looks at the stock price versus the free cash flow estimates, and it's pretty compelling if you take a very kind of literal textbook look at the stock and say, hey, is this, what am I buying here? Obviously the price has gone way beyond it. However, it did this last year too, and then the dip was bought, and we've had this event over the last 6 months. So, I mean, is it possible that Apple's new product lines and its services components can push that cash flow in a direction to make this line a little bit unreasonable? I mean, are you short Apple? Do you expect it to go down to get in line with where it was when the cash flows were at the same level a year and a half ago? Because that would be like $150.
We are short Apple today. We're short a number of tech stocks. During this tech rally, we had to pare back our shorts, no doubt, make some sacrifices and cut back positions. That's what you got to do for risk control. But recently, we've re-entered Apple and many other tech stocks, especially, and we've upped them, especially after yesterday's what we think was the first big down day move here. For tech stocks, that is going to mark the beginning of something, not the end. But we're short software stocks that are trading at 30, 40, 50, 100 plus times revenues. Apple's case there, free cash flow, growth has really been stalled. They've been buying back shares to increase free cash flow per share, but even if you look at enterprise value relative to free cash flow or stock price relative to free cash flow per share, you can see that the stock has diverged way too far to the upside in a bubble. And it's a good company, but can they increase their free cash flow at a rate to justify that valuation? We don't think so.
And by the way, the chart obviously is before the Apple split there. So we're at $120 right now. Here's the way the market just closed up. Stick with us, Kevin. I got a few other questions for you. And we are down on the day still. NASDAQ wasn't able to pull it off, but it did make a solid run here off the lows. 11,622 is where we finish. The Russell 2,060 basis points outperformance there, as well as in the Dow, as we did see banks hold up throughout the selling. Financials never turned red, and if they did, it was only for a second because I was watching all day and it's been green. So that's where things were strong. Kevin, what about the idea that some of the things that worked today and yesterday, banks, industrials, I mean, are there other stocks you can be in that are within the equity asset without being in actual miners? Is there anything you like outside the miners?
Well, it's funny that you mentioned the biotech stocks or the vaccine stocks in particular, but the biotech and the large cap pharma have been the only other industry group in our model that has any kind of reasonable valuation and growth fundamentals to justify those valuations. But
wait, a bear who's in vaccine stocks?
Pardon?
A bear that's in vaccine stocks. You don't hear that one very often.
Well, and we just finally took all our profits in the vaccine stocks, but we still do own large cap pharma.
So, Kevin, you like the miners. There's another chart you have that shows debt to assets. I think this one's pretty interesting as well, just given obviously how stark this difference is. Way on the other side of the spectrum are companies like REITs, consumer discretionary, the utility plays as well that people have been loving as part of this low rate play. How much of the overall thesis for some of the moves you're describing, though, depend on a big move in the 10-year yield? I mean, is total debt going to be an issue if the Fed is able to control the bond market over the next 5 years, as it seems they think they can?
Well, debt is one of the fundamental problems and why we've had such poor growth overall in the global economy. We have just far too much debt to GDP. Corporations are also record leveraged. You're showing a chart there, I think, that shows how the mining industry is one of the least leveraged industries in the in the stock market today. But corporate debt is a problem. People think utilities, for instance, are safe, but they require, they require issuing more debt and issuing more shares in order to pay those dividends out of that wonderful negative free cash flow that they generate. So it's a misnomer. It's a bad idea to think that utilities are a safe haven. And we're not fans of that industry group or a number of other cyclical industry groups with the same problem: extraordinary leverage, negative free cash flow in many cases in industrials, and it's not just tech stocks that are overvalued in this market.
Sure.
Aside from gold mining stocks and big pharma, it's just about everything.
And the bond proxies as being overvalued, I mean, it seems to be a very reasonable case to make. As we were just talking in the last block, it looks like the bond yields could finally be free to roam here. But just the last point to come back to this, Kevin, is in your models, when you look at this, I mean, because I've heard the bear case on the bond proxies and stuff for years now, and nothing's ever broken them because rates have never really been able to move. Is there something in your model and your calculations on a 10-year that needs to happen, a level or an elevation? We got to go for yields to finally crunch some of these trades and some of these valuations?
I actually don't think that's necessary. I think it would help the case for crushing the valuations on those bond proxies if we had rising interest rates. I do think there is just as good a chance that the Fed is going to have nominal rates under control. We've got $8 trillion of Treasury bonds that are going to mature by the end of 2021. They're going to need to be rolled over. Fed's going to be stepping in a big way to help to accommodate that. We have more money printing, but there's a lot of debt in the world. U.S. Treasuries still have a premier spot in the world as we're still the world reserve currency here in the U.S. and Treasuries are still one of those premier assets. And I think the Fed has got yields under control. We will see. But what they don't have under control is real yields. And what we're really going to see here with the Fed holding nominal yields down is declining negative and declining real interest rates. And that, once again, is the big driver for gold and precious metals. And ultimately, it's a downturn in the economy that's going to, like we saw in March, that's going to crush the utilities and the REITs when it comes to performing. They're just not going to be able to generate the free cash flow to justify their valuations and to pay and to be able to service their debt.
Okay, Kevin, appreciate the update on the case, and congratulations on the year. Appreciate you joining us.
Thank you. Thanks, Oliver.
Kevin Smith is a founder and CEO at Crescat Capital. Go follow him on Twitter, Crescat.